Hello everybody. In this session we are talking about futures exchange. A futures exchange is a marketplace where all types of futures and options on futures contracts are bought and sold. Those allow access to the exchange are brokers and commercial traders who are members of the exchange. Members need to be registered with National Futures Association and the Commodity Futures Trading Commission. Individuals who want to trade futures contracts must have an account with a registered broker. Futures exchange also provide clearing and settlement functions. And then we move to key features of futures exchange. The key features of a futures exchange include the first, standardization. Futures contracts are standardized in terms of the underlying asset, contract size, expiration date, and other specifications to ensure consistency and transparency. And then the second, clearing. Futures exchanges have a clearing house that guarantees the performance of the contract, reducing the risk of default. Third, marking to market. Futures contracts are marked to market daily, meaning the value of the contract is adjusted to reflect the current market price. And fourth, margining. Traders are required to post an initial margin, which is a percentage of the contract's value to cover potential risks. And then we move to types of futures contracts. There are several types of futures contracts, including the first, exchange traded futures. These are standardized contracts that are traded on an exchange and settled daily. They can be used to hedge or speculate on various commodities such as corn, wheat, soybeans, and crude oil. And then the second, options on futures. These are contracts that give the owner the right but not the obligation to buy or sell an underlying asset at a predetermined price and time in the future. They are typically used by investors who want to limit their risk exposure. And then third, forward contracts. These are private agreements between two parties to buy or sell an underlying asset at a future date. They are not standardized and are not traded on an exchange. And then fourth, over-the-counter or OTC futures. These are privately negotiated contracts that are not traded on an exchange. They are typically used for more complex products like interest rates, currencies, and stock index. And then we move to Jakarta Future Exchange or JFX. This is especially in Indonesia. Jakarta Futures Exchange or JFX or PT Bursa Berjangka Jakarta is the first commodity exchange in Indonesia established under the Indonesian law number 32 1997. PT Bursa Berjangka Jakarta was established on August 1999 by 4 palm plantations, 7 refineries, 8 coffee exporters, 8 securities companies, and 2 general traders. Of the 40 billion capital authorized, capital paid up was 11.6 billion rupiah. The Bursa Berjangka Jakarta, or better known as Jakarta Futures Exchange or JFX, met all the requirements stipulated in the law number 32 1997 and received business license from the Kaftura Bapepti in the mid of 2000s. Initially, JFX traded contracts on plain and Robusta coffee, later expanding its scope to gold as well as crude palm oil in 2001. In the 2002, JFX decided to terminate the trade of CPO and Robusta coffee contracts due to scarcity of demand. The new contract, which is successfully marketed, is the Cocoa contract, and JFX has also developed the JFX Sharia, which is the first Islamic-based commodity trading in Indonesia. In December 2013, JFX launched new products which consist of Arabica and Robusta coffee contracts, and then rubber physical market and periodic pollen cold contract. And then we move to benefits and risks of futures exchange. The benefits and risks future exchange include, the first, risk management. Futures contracts can be used to hedge against price fluctuations, reducing the risk of losses. And then the second, volatility. Futures markets can be highly volatile, making it difficult to predict price movements. And then third, leverage. Futures contracts are leveraged, meaning that small price movements can result in significant losses. And fourth, speculation. Futures contracts can be used to speculate on price movements, potentially generating profits, and however, there are also risks associated with futures exchange. And then we move to the factors influencing future prices and market volatility. Factors influencing future prices and market volatility include various economic indicators such as interest rates, inflation, employment data, and GDP growth. Other factors that can influence future prices and market volatility are geopolitical events, natural disasters, weather patterns, and changes in government policies or regulations. Additionally, technical analysis and psychological factors can also play a role in determining future price and market behavior. I think it's in our session. Thanks for watching, and don't forget give this channel with your comment, subscribe, and share. Thank you.